Welcome to Bank Director's online training series in the unit on bank regulation. My name is Jim McAlpin, and I'm a partner in the Financial Institutions Practice Group at the law firm Bryan Cave in Atlanta. This unit will be offered to you in two segments. Part A will provide you with foundational information, including the board's role in the regulatory process, an explanation of safety and soundness supervision, and an overview of some of the important regulatory issues that your institution needs to be aware of. Part B will focus on best practices in regulatory compliance and provide insight into the latest regulatory developments. So let's get started. It's hard to avoid being somewhat technical in a discussion of bank regulation, but I'll do my best to keep this video from being too dry. To that end, I'd like to begin with a comparison of the banking business to a football game. I'm from the South, and college football is never far from the minds of Southerners. The average bank director is a successful business owner or executive, and many aspects of the banking industry will seem familiar. Banking, like any for-profit business, is fundamentally about earning money and enhancing shareholder value. The board of a bank needs to ensure there is a well-thought-out business strategy and an effective senior management team in place. As in any industry, there are winners and losers in the banking industry. A key difference between banking and most other businesses, however, is the active involvement of referees in the form of the state and federal regulators. I've been watching college football games for many years, and there is a clear difference between games when the referees are aggressive and throw a lot of flags, and games when the referees are more passive and throw fewer flags. Just as football games are influenced by referees, the banking industry is influenced by regulators. Directors often ask me why the banking industry is so highly regulated. Why is there so much red tape, especially for community banks that have a more difficult time rationalizing the cost of regulation than larger institutions? The first reason is the Federal Deposit Insurance System, which provides coverage of up to $250,000 per customer, per account, per bank. Our deposit insurance system was created by the Banking Act of 1933 and came out of the Great Depression. Congress saw then, and still sees today, a compelling policy motivation to include a safety net in the country's banking system. It is the security and peace of mind that deposit insurance provides to customers, businesses, and government entities that allows your bank to collect deposits at a low rate and lend it out to your borrowers at a much higher rate. The price that banks pay for this access to below-market funding is, first, the cost of operating the deposit insurance program, which your bank helps finance through the insurance premiums it pays to the Federal Deposit Insurance Corporation. And second, a system of government oversight to make sure banks are operating in a safe and sound manner. Another reason why the banking industry is regulated is that healthy banks are crucial to a healthy economy. We saw a demonstration of this relationship during the financial crisis of 2007 to 2009, when the failure of Lehman Brothers and several large financial institutions and the near failure of American International Group set off a global credit crunch that helped push the U.S. economy into a sharp recession. A major piece of banking legislation that we will cover a little later in this segment is the Dodd-Frank Act of 2010, which was a direct outgrowth of the recent financial crisis. Dodd-Frank places a number of new regulatory requirements on banks for the purpose of controlling the systemic risk that a banking crisis and the failure of a large financial institution poses to the economy. It's easy to complain about excessive government oversight, but to be successful, your bank needs to be able to function effectively within our industry's regulatory system, and it can be done. Recently, a team of researchers at the Federal Reserve Bank in St. Louis undertook a study of 700 banks that weathered the financial crisis in excellent shape. All received the highest possible rating on the CAMELS rating system that regulators use to evaluate a bank's safety and soundness. The average return on assets for this group of banks from 2007 through 2011, which included the years of the financial crisis, was 1.54%, and the average return on equity was 12.7%, both of which are excellent results. One of the takeaways from this study appears to be that it is possible, even in a recession, to comply with a demanding regulatory system and still run a highly profitable bank. Let's talk a little bit about the role of a bank board in the regulatory process. It's important to understand that in the eyes of your primary regulator, the board ultimately controls what happens at the bank. Even though management runs the bank on a day-to-day basis, it's the board that is ultimately accountable for any deficiencies in the bank's operations, including regulatory violations. The regulators expect boards and their individual directors to be fully informed about what is going on inside the bank and to exercise sufficient oversight of the operations and the policies of the bank. Boards need to self-police and take the initiative to engage management about the condition of the bank. Sometimes boards make the mistake of relying on their regulator to uncover problems at the institution and bring them to their attention. The OCC warns against this in its publication, The Director's Book, The Role of a National Bank Director, which is available on the OCC's website. Let me read you a quote from that publication. "The activities of OCC examiners do not diminish the board's responsibilities to oversee management and operation of the bank. Directors are independently responsible for knowing the condition of the bank and should not rely on the examiners as their sole source of information to identify or correct problems. Instead, the board should look to its senior management, its auditors, and other outside experts to identify and correct any problems." As far as the regulators are concerned, the board is the first line of defense. It's also the board's role to make sure that management has instituted an effective regulatory compliance program as a safeguard against serious violations that could put your bank in the penalty box. For example, violations of the Bank Secrecy Act or other anti-money laundering statutes could result in enforcement actions that would prevent your bank from being able to take important strategic actions, like an acquisition or expansion into a new business line. The foundation of a good relationship between a board and its bank's federal and state regulators is communication. A best practice is for key board members, such as the chairman of the board and one or more committee chairs, together with senior management, to meet with the examiners prior to a safety and soundness or consumer protection examination, and then again afterwards to review the results. Separate from the examination process, a bank board should not be hesitant to seek a meeting with its primary regulators if the board has questions or concerns, and engage the regulators in an open and candid manner. Disagreements can and will arise, but it's never in the best interest of the bank for the relationship with any of its regulators to become overly adversarial. And the board can play a leading role in making sure that that relationship is as constructive as possible. Let's talk now about how banks are regulated. An important aspect of the industry's regulatory architecture is something called the dual banking system, which refers to parallel state and federal regulatory systems that have been in effect for nearly 200 years. Commercial banks and savings associations can operate under either a federal charter, in which case they are subject to federal banking law and supervised by a federal agency, or under a state charter, where they must adhere to the laws of their state of domicile and are overseen by a state regulatory agency. National banks and savings associations once enjoyed certain exemptions from state laws that gave them special privileges denied to many state banks, like the ability to sell insurance or exemption from state consumer protection rules. But the level of federal preemption that national banks have traditionally received was substantially reduced by the Dodd-Frank Act. Today, whether you have a state or federal charter matters less in terms of what your bank is permitted to do than does the governmental entities that end up regulating you. And in reality, the two regulatory systems are not fully separate and distinct, but actually overlap in some respects, as you'll see in a moment. There are 4 federal agencies that collectively oversee the entire banking industry. The Office of the Comptroller of the Currency, or OCC, supervises national banks and savings associations, of which there are nearly 2,000 in the United States. It operates as an independent agency within the U.S. Department of Treasury and is headed by the Comptroller of the Currency, who is appointed by the President to a 5-year term and confirmed by the U.S. Senate. The FDIC is an independent agency that oversees the Bank Deposit Insurance Fund. It also manages the resolution process for failed banks that have been placed in receivership and directly supervises approximately 4,500 state-chartered banks that are not members of the Federal Reserve System. It is also the backup supervisor for the other insured financial institutions it doesn't supervise directly. The FDIC is governed by a 5-member board of directors who are appointed by the President and approved by the Senate. The board includes a chairman who also serves as the agency's chief executive. The Federal Reserve Board sets monetary policy in its capacity as the country's central bank, and it supervises state-chartered banks that are members of the Federal Reserve System. All banks and thrift holding companies, and the foreign activities of U.S. banks and the U.S. activities of foreign banks. Last but not least, the Consumer Financial Protection Bureau has responsibility for promulgating and enforcing federal consumer financial laws and for supervising consumer protection compliance at a variety of companies, including banks, with $10 billion in assets or more. The CFPB operates as an independent agency within the Federal Reserve and has a director who serves as its chief executive. Under the dual banking system, banks and savings associations that have state charters end up being supervised at both the state and federal levels. In fact, a state-chartered non-member bank that is over $10 billion in assets and has a holding company would end up being supervised on several fronts. First, by its state regulatory agency in the FDIC at the depository subsidiary level. Second, by the Federal Reserve at the holding company level. And third, by the Consumer Financial Protection Bureau examining its compliance with consumer protection rules. In their oversight roles, the regulators for your bank will conduct periodic examinations, beginning with a safety and soundness exam, which occurs every 12 to 18 months depending upon the size, health, and complexity of the bank. To make this safety and soundness assessment, the regulators use a supervisory rating system known as CAMELS, spelled C-A-M-E-L-S, which is an acronym made up of the system's 6 components. The C is for capital adequacy and looks at how strongly capitalized the bank is relative to the amount of risk it is taking on. The A stands for asset quality and is an evaluation of the quality of loan underwriting, policies, procedures, and practices. The M is for management capability and is an assessment of how well senior management and the board are running the institution. The E looks at the quality and level of an institution's earnings. The L refers to whether the bank has adequate liquidity and determines the competency of its asset liability management program. And the S stands for sensitivity to market risk, which includes a wide variety of market and economic factors. The CAMEL system uses a 1 to 5 rating scale, and your bank will receive a separate rating for each of the 6 components. A 1 is the highest and best possible rating, while a 5 is the lowest and worst. The bank will also receive a composite rating, which reflects the examiner's overall assessment of an institution's safety and soundness, including the examiner's qualitative judgments. A composite rating of 1 is the highest rating and reflects a high level of financial performance and risk management practices. A composite rating of 5 signals that the bank is at risk of failing and is in need of immediate corrective action. Banks that have received composite ratings of 4 or 5 operate under close regulatory supervision and have entered into some type of official enforcement agreement that requires their board and senior management to take specific steps to avoid further deterioration in the bank's condition. Most 3-rated banks have also been directed by the regulators to strengthen certain aspects of their operations based on the outcome of the safety and soundness exam. It is not uncommon for a 3-rated bank to be subject to an informal agreement with its regulators regarding the aspects of the bank that must be improved. During the safety and soundness exam, the examination team will meet regularly with management to get access to information or discuss issues that have come up. Once the team is finished, it will prepare a report of its findings and hold a meeting with the board to review the results of the exam. Each director is required to read and sign the report of examination, and the board is accountable for seeing that management corrects any problems that have been identified in the exam report. If you are new to the board, I would suggest that you read the last few examination reports to familiarize yourself with the regulator's assessment of the overall condition of the bank and any issues that might have come up. Your federal regulator will also conduct several other types of examinations, including a review of the bank's compliance with consumer protection laws, such as the Truth in Lending Act, and whether the bank is meeting the credit needs of its community under the Community Reinvestment Act. Depending upon the nature of your bank's operations, your regulator might also conduct more focused specialty examinations that look at specific areas like information technology controls or compliance with the Bank Secrecy Act. If your institution has a holding company, the Federal Reserve Bank in your district will conduct a separate examination that looks at the holding company's managerial and financial condition and makes an assessment of whether the holding company continues to serve as a source of strength or poses a risk to any of its depository subsidiaries. And if your bank or thrift has $10 billion or more in assets, you are also subject to a periodic examination of its compliance with a variety of federal consumer protection laws by the CFPB. Now, it is not uncommon for a regulator to take a position in an examination that a bank's senior management or the board disagrees with. If this occurs, don't be afraid to argue your position, but do so in a manner that stops short of being confrontational. The earlier in the examination process that such a discussion begins, the better the prospects of reaching a satisfactory accommodation on the issue with the regulator. If you are not able to resolve the disagreement with your regulator's field staff, each federal banking regulatory agency and most state agencies have an established appeals process that will enable a bank's management and board of directors to dispute the findings of an examination that it believes are unfair or incorrect. If we were to cover all of the important federal banking laws that your institution must comply with, it would take an entire day, and we would only be scratching the surface. I think it's more useful to point out that the concerns and emphasis of the regulators will change over time as they apply the lessons of the past and in response to where they see the greatest amount of risk going forward. The event that has had the greatest impact on the banking system in recent years was undoubtedly the last financial crisis, when 465 banks failed between 2008 and 2012. The landmark Dodd-Frank Act was a result of that crisis. Once the lengthy rulemaking process has been completed, it will have a tremendous impact on capitalization levels, risk management practices, and consumer protection practices throughout the industry. A primary focus of the regulators today is on making sure that banks have sufficient levels of capital to survive a sharp downturn without government assistance and without doing great damage to the U.S. economy. The new Basel III rules will require all banks to carry higher capital levels and to use somewhat different capital structures than in the past. The regulators are also very concerned about a variety of risk management issues, including operational risk, cyber risk, compensation risk, and the dangers of over-concentration in volatile asset classes like commercial real estate. Anti-money laundering laws, including the Bank Secrecy Act, continue to receive the regulators' attention as the war on terror remains a high priority of the U.S. government. The widely shared perception in Congress that widespread abuses like predatory mortgage lending helped precipitate the financial crisis led directly to the creation of the Consumer Financial Protection Bureau and a much greater emphasis by all of the federal regulators on consumer protection. Even if your bank is too small to be directly supervised by the CFPB, you can expect your regulators to place much greater emphasis on consumer protection compliance going forward. It's also possible, and perhaps even likely, that the CFPB will use its rulemaking authority to rewrite existing consumer statutes and also promulgate new ones from more of a consumer activist stance. This could have a significant impact on all banks regardless of their size. Banking is a very dynamic industry. And while these are some of the regulators' top concerns today, their priorities will most likely change as the industry changes. I would recommend that every board ask its senior management team and the bank's outside advisory firms to make regular presentations at its board meetings on some important aspects of regulation so that you can stay fully informed. As I bring this video to a close, let's review some of the key points that are important to remember. First, regulation of the banking industry is primarily a consequence of the FDIC's deposit insurance program, which provides an extremely important economic benefit to your bank and also reflects the potential systemic risk that banks can pose to the U.S. economy. It's possible to be a high-performing bank while also conforming to all federal regulatory requirements. The regulators expect every bank board and every individual director to be fully informed about the condition of the bank and to be the bank's first line of defense. The banking industry operates under a dual charter system, which determines which regulatory agencies are responsible for supervising your bank. The federal and state regulators use the CAMELS rating system to evaluate the safety and soundness of your institution. And this system emphasizes capital, asset quality, management capability, including the board, earnings, liquidity, and sensitivity to market risk. The board needs to pay attention and be responsive to the results of the regulatory examination of the bank. Any criticism of the bank's operational effectiveness or regulatory compliance, which are contained in the exam report, should be discussed by the board with the bank's management and then addressed prior to the next regulatory examination. These criticisms are the flags that are thrown by the regulators in their role as the referees of the banking industry. Bank regulation is a dynamic process that changes over time. And today, the regulators are placing particular emphasis on capital, risk management, consumer protection, and compliance with anti-money laundering laws. The areas of regulatory emphasis change over time. It's important for bank directors to keep abreast of both developments in the industry and evolving regulatory priorities. Your bank will be well served if you do so. Thanks for spending this time with me. Now let's move on to the next video on regulation, where we will examine some important recent developments and also identify best practices that your board should consider adopting.